We can go live now, sir.
Yeah, I'm just posting it. Can start.
Yes, sir.
Hi, good morning, and welcome to question 9 for the month of March. As is usual in this format, we do this once a month. We do a webinar in three languages: English, Hindi, and Tamil at the beginning of the month. And then towards the end of the month, we do this question hour where I not only just give an update on what happened in our view in the economy and the markets and our perspective way forward, and then we are open. I've got lots of questions already on the various social media and happy to take any more live questions too. So without much ado, let me now begin my quick PPT for 15 minutes to give you an update since our last monthly update, right? So starting with our worldview, right, we believe that the global economy is in a wondrous state of a synchronous recovery. The reason being that the stimulus was well synchronized, the vaccinations are well synchronized, and the liquidity plus the fiscal stimuli, all of them are showing their effect on various economies, right? So this liquidity combined with the fact that the fiscal deficit of the US is expanding because of this pumping liquidity, the dollar is getting weaker, means that emerging markets are getting a fillip from this. On commodities, there has been strength because the Chinese recovery was first, but we think that as the Chinese credit cycle is moving closer to the peak, we don't expect too much of a spike further, right? Output gaps in all economies are far from closing. That is, the demand supply gap is huge, right? And while liquidity is driving earnings and multiples, stock selection will always be key for us, right? Now, if you look at the synchronicity of the recovery, what I mentioned, look at it. 89% of the world's economy, compared the PMIs, the Purchase Manager Index, month on month are showing an expansion. Only Mexico and Hungary are showing a decrease. All the rest of the countries are showing. That's what I meant by a synchronous recovery, right? And the weak dollar comes because of the twin deficits, current account deficit and fiscal deficit of the US expanding more and more. That's why the dollar index is getting weaker, right? Crude, right? With OECD and liquid fuel commercial inventories roughly being stable, we are seeing a reasonably firm but stable oil price situation. The flood equity expected to continue if you will go forward. In addition to the 13 trillion this year, we expect another 29 trillion within the next 2 years to come through into the world economy and especially from the US. So this is the Fed's balance sheet expansion plans. I think that we think that Jan next year is when we see Fed likely to begin tapering in terms of rate pause, in terms of pulling back the liquidity that they have already put in. From that situation of a synchronous global recovery and ample liquidity, India has also been riding the recovery wave very, very well, right? So starts off with an excellent vaccination schedule. In fact, we are producing more than enough of the vaccine. We are exporting it to a lot of countries. And of course, we are in a position to cater to, I think the ages up to 60 have already been open to vaccination. I think starting from tomorrow, age 45 and above, and we think in the next 3 to 4 months, this barrier will keep coming down. So that I think India has been at the lead and the forefront of the vaccination situation, right? So various indicators of recovery, we look at GST first. As you can see, after the sharp drop in April last year, it's back on a V-shaped recovery and hovering around the 1.2 lakh crore mark, and we think it has potential to rise higher. That's good news for the government's fiscal deficit, and it's reflective of the economy's recovery because GST is pretty much charged on every product that you see except for petrol and crude, right? Truck freight rates. As you can see, all of them showing a slightly more gentler V, not a, is more closer to a U than a V, but the recovery is clear across the country, right? Then if you see exports, two-wheeler sales, power demand, GST connection, passenger vehicles, rail freight, all are on a strong V-shaped recovery path, right? So overall, the economic recovery index, if you calculate, right, we think we are at about 95, 96% of the pre-COVID level already. So the economy has got back to its pre-COVID levels, we would say. So as a result, if you look at the GDP projections, the projections have got continuously revised upwards and upwards to the extent that from a 25% negative for the first quarter, we are at 7 negative and a zero point 0.4 positive. And this quarter onwards, you'll see the positive going. As you can see, there's a 28% shown for April, May, June. That's the base effect of a 24% negative. One of the questions which came in, and it's probably useful to answer it, somebody said 12% GDP growth next year. How confident are you? One of the reasons for the confidence coming in is because one is, like I said, India's vaccination schedule, we have controlled it. There are pockets of second waves coming, but I think the government will be happy to reintroduce partial lockdowns to control it. So we remain confident that the economic activity will not suffer so much. Second is you have the base effect impact of the previous year, right? The sharp correction means that your base of GDP itself came down. So a 12% on a reduced GDP, on a normalized GDP, what would be 6 to 7% is reflecting as 12% on a reduced GDP. So I think that's the reason. It's a little bit to do with the numbers, but also at the same time, it indicates the strength of the Indian recovery, that from a deep negative, we are able to go to a strong positive. Right now, this is the short-term outlook. In the medium-term outlook, there are three structural forces which are giving a good boost to the Indian economic growth. Another question was how sustainable is Indian economy's growth? So there, if you see, the three sectors are housing sector, then the sectors covered by the production linked incentive PLI scheme of the government, and then the national infrastructure pipeline, where the government has laid out a 100 lakh crore, 100 trillion rupees of expenditure over the next 5 years, right? What is the reason for this? Because in the housing side, if you see the affordability today is at an all-time high. What we last saw in 2003-4, we are now approaching those levels of affordability of housing. What do you mean by affordability? What it means is that if you were to borrow today and you get a tax break for housing, and if you were to rent it out and you get a rental yield for the property, that gap has narrowed to 3% today, as high as 7% earlier. So not only is it a good time to buy a house to live in, because interest rates are at an all-time low, 6.7% is roughly what you're getting from a 25, 30-year loan from the leading housing finance institutions in the country. So such a sweet spot means that we expect the housing sector, and the housing sector's recovery is a very clear multi kind of multiplier effect. Why do I say this? Because when a house gets built, cement, steel, copper, aluminum, wiring, ceramic tiles, paints, woodwork, everything gets a huge boost. So the economy gets a very widespread effect from the housing sector. So we believe that housing is going to lead the recovery. And of course, real estate companies and housing finance companies will benefit from this. The next is the national infrastructure pipeline, the expenditure by the government, right? So if you see here, energy, urban infrastructure like metro, roads and railways account for 70% of the projected. So almost 70 to 75 lakh crore is going to get spent. And again, a spillover effect on steel. And that's why you see steel outlook for India has so changed dramatically, because steel demand is going to go through the roof over the next few years, right? The third thing is that the budget, which gave a boost to capex, if you recollect, right? There was something like a 5.5 lakh crore expenditure on capex this year. So that will create its own multiplier effect. Now we come to what is called as a PLI scheme. Now, the PLI scheme is nothing but government giving an incentive to somebody coming from overseas and putting their manufacturing capacity into India. Whether they want to sell in domestic or re-export, we are neutral. But mostly all of this is re-export, because these are the kind of products which the Western world demands and which was hitherto manufactured in China. So naturally, in terms of industries, you will see the list. These are mobile, automobiles, battery, food, pharma, textile, telecom are all in these schemes. What is the scheme? The scheme is basically saying that whatever raw material you use from India, okay, we won't give an incentive on that. But whatever value addition you put on that, right? 5% of that government will give you back as cash, which means that you are actually subsidizing the cost of your project through the government of India. So for the 5 years you subsidize, after that the factory will be there for 20, 25 years, the government is going to reap the benefits. So government is taking a short-term 5-year outlook to boost this, right, from the thing. So the GDP impact from this is almost 1.8% of GDP that we believe will come from this, the growth in GDP, right? So that is a huge thing. Why the PLI announcement now? Because the Make in India was too broad and it didn't take off at all. There was a lot of hype around Make in India many years ago, but this is a very specific action they're taking to make the overall Make in India a success. But in the Make in India program itself, what are they envisaged? They said we'll make it tax friendly for common. So we reduced our tax from 35 to 17 at par with the best in the world. All our expenditure on infrastructure meant that we have improved in the ease of doing business. So foreigner looks at India with different eyes. China, which is from where we expect to get most of this business, China's labor supply, the red line, is decreasing. Our labor supply is increasing for the next 30 years, right? So in this short-term positive trend and a long-term supportive bullish trend for the economy, the stock market is reflecting this outlook in its performance, right? And one of the main reasons for that is that FIIs have bought on this, both the short-term recovery and the medium-term recovery. And as you can see here, compared to all other emerging countries, India is the only one consistently to get positive flows from FIIs, right? Right across the range of periods, right? This means that this story that we spoke so far is something that the foreigners are comfortable with, that it will happen. And a lot of this money is long-term FII money coming in the hope that the GDP, which grows, the stock market will respond and they'll make high gains from the Indian stock market, right? And hence, if you see when the downturn started in the Indian stock market from 2017, when the economy went to slow down, India's premium with respect to world and emerging countries, both India is always at a premium, more or less. World less so, but emerging countries clearly we are at a premium. Had corrected sharply, if you see the right hand extreme, and that started reversing with these new FII flows coming. India's PE premium has started rising again. So India being at a premium is a given at all times. There was a correction, but that correction is now getting set right. But it's still not back at the previous highs. If you can see, in August 2018 was when the previous high in terms of premium was, right? So it's still not reached that. So there is still scope for further FI money to come in and Indian valuations to go up. Remember one thing, the P ratio, if the actual earnings comes up, the P ratio will not rise so much. So that's the thing, that the premium is justified from the earnings outlook of the Indian economy, right? And corporate balance sheets have seen resilience in India. In the downturn, they have cut costs, they have cut debt. This is what these slides are showing, and their debt equity ratios has significantly improved. So a healthier corporate India post the crisis is a good news for these people, right? And hence what is happening in these two, don't get too confused by these lines. The fact of the matter is that earnings expectations of companies, what analysts are predicting, the actual earnings are coming better. Hence, analysts are revising the forecast, then they are beating those forecasts. So the reason for the stock market rising is whatever is priced into the price is not enough and their price needs to rise more. So that's the analyst revisions which has been driving the flow of money into the Indian stock market, right? The same slide put in another way, which explains what I just explained, right? Hence, from a fact that Nifty, right, where we expect it to be in terms of EPS growth, you can see there's a strong, sharp rise expected from a 536 EPS for this year to 713 for next year and 856. So it is this medium term, and this is just a large cap story that is driving all that FII flow into the Indian stock market, right? So as a result, as you can see from the three curves, right, the P ratio of the Nifty, the mid cap, and the small cap, all after falling sharply in March, have now started rising and are going close and sometimes exceeding their previous highs. So the Indian markets appear to be reasonably priced if you take the growth into account, right? But what has happened is since the December 17 peak of the market, if you see the various indices, how they have moved, the P ratio of Nifty has expanded 5.7 from a 17.8 to 23.5 because foreigner money has come in, as I showed you. But the mid cap index has actually not yet reached the previous peak, and the small cap index has just about reached it. So today, if you look at the table below, the mid cap index and small cap index are still trading at a discount to the Nifty. So if you look at the fact that in a bullish economy, the earnings growth of mid and small caps tends to be greater than that of large caps, you will realize that this discount plus the faster earnings growth means that it's probably a sweet spot to invest in the mid and small cap space today, right? which is exactly what this graph is saying, that when the economy does in good phases, you can see the rise and fall in the graphs, right? So the rise is a good phase, the fall is a bad phase. We call them virtuous cycles and vicious cycles. So if you see the economy at the very end of the graph has gone into a virtuous cycle, and the growth of the large cap index is 90% since the March low, mid cap 106, small cap 127. So this slightly faster is a view of the future, because if you see the very first table here, which is the original bull cycle of 2003 to 8, you can see that actually the rate of return of mid cap and small cap was multiple times that of large cap, whereas here it's just about 20-30% more. So the scope as this bull cycle plays out for the mid and small caps to actually catch up and grow faster than the large cap index is quite strong, right? So overall, to summarize now, my what is outlook is the blue wave, that is the democratic wave, is going to help policy growth and global trade. The vaccination drive and liquidity is going to help the lubricate economy. Synchronicity in the stimulus, vaccination drive, the democratic reviewers, weak dollar, contained commodities, and continued liquidity are the key global events. In India, what do you see? COVID has pushed India into phase of formalization, which had resisted during demon. E-commerce related firms and FT financial technology firms have disrupted the services space. Rural India remains strong. Easing inflation is helping RBI keep rate low for longer. Domestic manufacturing is short in arm from the back of the China plus one shift, global demand, as well as PLI schemes announced. Housing recovery we spoke about. Construction, manufacturing, exports naturally are going to be the key areas of focus. We should end without no, you should not end without looking at the risks to whatever we have painted as a very positive story. So what is the risk? COVID. Do we not control the infections abroad and in India? Yes, that's a risk. So that's one thing to take care. Dollar, we are expecting weakness. What if the dollar strengthens instead? That is, American economy recovers very fast, means that. So that's actually not good news for the markets, though that may be good news for the Indian economy. Sharp rupee depreciation, independent of the dollar strength, right? Indian rupee, if crude prices rise, and that's what we have seen, commodity and crude rises, India is a net importer. If the rupee depreciates, then foreigners would hesitate to put money into a weakening currency country, right? So commodity prices, we are expecting them to be soft, but if they rise, it could lead to inflation, and hence the US will try to counter inflation by hiking rates and paring back the bond purchase. That's a risk. And in India, we've had luckily some good monsoons. But this year, if the monsoon comes bad, then it could mean food prices rise, inflation rises. And our RBI also could shift the focus to inflation and start pulling back liquidity. These are the risks that you need to keep an eye out for. So overall, from a portfolio perspective, from Sundaram's perspective, this our approach is going to be to capture reasonably valued stocks with growth focus. That's the underlying thing. But overall, we are positioned for the investment cycle's resurgence and the consumption story now playing out. And we think that in that space, financials, consumer discretionary, building materials, auto, and industrials are the key wealth creators. Global recovery, as and when it happens, we will play it through materials like metals, specialty chemicals, auto ancillaries, which get exported, and IT services. We believe that Indian IT will benefit from this multi-year, what the COVID crisis has forced the world into a cloud kind of a situation, and the digital transformation that's happening. But still, all being said, it's not a blind buy and hold. Stock selection is very critical because the large macro trade has happened. There's money flowing in and taking up everything. From one on one, you've got to be careful about the stocks we pick. But we expect rising participation from mid and small caps, given the economic environment is vastly improving, right? So in terms of our sector views, the green tells you where we are overweight: private banks, IT, infrastructure, financial services, building materials, telecom and media, retail, and chemicals, services, and some amount of real estate. Where are we underweight? Oil and gas, right? FMCG, because we believe that it's a safety play which is now going to take a back seat. And pharma, we believe the run has already happened. And on utility space, right? Where are we neutral? We are neutralish on NBFCs because there's a good and a bad. So overall sector wise, we are neutral. Oil and gas, we were underweight. We've just moved to neutral. And PSU banks, because there again, it's a very stock specific action. So overall on the PSU banks, we are maintaining neutral. Some we are very bearish, some we are reasonably bullish. Ferrous metals, like we said, commodity cycle, we expect it to stabilize. So ferrous, we are neutral. Capital goods, we are neutral, as well as non-ferrous metals, right? So that summarizes our view in terms of this. So I think with that, I'll close the presentation. And the first question that I'd like to answer here, which has already come in, is something that I need a slide for, after which I'll probably take off the slide, is about Sundaram mutual funds performance. That question was that our fund performance is taken a beating. When do you expect a recovery? So I've just put up the data as of yesterday, right? And you take a range of our funds. Almost all our equity-oriented funds are here. So what this table says is which category is that equity fund in, and then it tells you the number of funds in the category and gives our ranking. So what I want to draw attention broadly is that if you look at a 2-year, 1 year, 2 year, 3 year, yes, in number of funds we are in the bottom quartile. Yes, so the feedback is relevant that our fund performance has indeed suffered. What is the reason for that? The reason for that is that we had always positioned our portfolio 60 to 65% of our portfolios in mid and small cap, because that's the kind of money investors have trusted us with. In that context, from December 17, as you recollect the slide, we've seen the mid and small cap index is largely correct, right? And so our fund performance started taking a beating. But within the mid and small cap also, we were more exposed towards consumer discretionary, towards banking, and towards industrials, because we believed in the India story very strongly. That India story, as it took a beating, right? What happened is in the market recovery also we underperformed from March. The reason for that was that the recovery happened in the safety play. So though mid and small caps recovered, within them it was a safety play like an FMCG and pharma and IT which took the lead. Unfortunately, we were underweight in those because of our worldview, which didn't come out right. Now we see our view coming out right, but in the meantime, we have also reached the top portfolios. And so now I draw your attention to the 1 month, 2 month, 3 month, and 6 month return numbers. And you can see that you take some of our big funds, right? So a diversified equity, which was at the bottom, a tax-saver fund, has come now in a 3 months to 16 out of 41. So it is in the top half of the industry. Take our large cap blue chip fund. It's been consistently, it's a new NFO. It's at 15, 13, 14 out of 38 funds. So clearly in the top half, right? Take a select focus, a concentrated fund, right? Again, you take the 3 month, 6 month, 3 month, 2 month, 6 months. It's again around 13 to 20, right? Somewhere in the middle of the pack. Take a large and mid cap fund. Again, talking about a large size funds, right? Large and mid cap fund. See, if you look at it now, out of 29 funds, it has 3 months, it has already come to the 7th ranking. So, which means it's in the top quartile, right? Q1. Mid cap fund. Yes, it was underperforming 1 year on, it was 21, 22 out of 27 funds. But 3 months, can you see it has improved now to 12th ranking. So we believe that every one of these big funds, and if you take equity fund, the NFO which you launched earlier, 8th rank out of 16 funds, right? Take the services fund, 13th rank. So if you look at it from that perspective, right, our funds took a beating, undeniably. That's why the longer term returns got affected. But the shorter term, can you see the path has moved forward? We have put in place a lot of processes, systems to make sure that we remain around the benchmark, that we take whatever flexibility the SEBI's rules allow in terms of large cap, mid cap components in our funds across the board. And you can see that there is an improving trend by and large coming into us from a 6 months perspective. We hope to sustain this and hope to see that by the end of the next quarter, the June quarter, we should definitely be seeing a change. Incidentally, in this process, right, our CIO, Mr. Krishna Kumar, has also decided to move on. Right, so he was largely responsible for this. He has decided to pursue other things, and so he will be leaving. We are already in the search for a good CIO from the marketplace, and hence we hope that by the end of the quarter, we would get one of the top ranked fund managers from the industry to oversee this process now in terms of making sure that we take less. So to summarize it, Sundaram was taking a very high risk, high reward kind of a positioning. And that's why those risks didn't pay off in terms of reward. We are now consciously moving to a lesser risk, lesser reward, more multi-cap from a concentrated mid and small cap portfolio, and more process-oriented approach is what we are trying to do, right? So in that context, right, I remain confident that over the next 3 to 6 months, you'll see Sundaram back among the top ranking funds in the country, especially in some of our key funds, right? So that's the first question. So Shweta, you may now proceed to ask the other questions. I'm going to stop sharing the screen.
Yes, sir. The next question, sir. When will real economy pick up?
No, I don't know what the question actually refers to in terms of the real economy, because we do see that the IIP numbers are better. We see that the PMI numbers are better. We see that GST collections are improving. So I think the recovery trend is already there. So I think the real economy, I think, has started. Housing sector is showing recovery. So you will see demand happening. You can see construction activity all over the place starting. So I think the process has started. So fully to complete the recovery, you'll have to give it another 6 to 9 months. But the green shoots are already there.
Next question, sir. What is the impact of bank mergers on the stock market?
I think the impact of bank mergers will be that the PSU stocks will get re-rated, because the weaker PSU stocks, which are today hammered by the market, right? As they get merged into a larger bank, naturally their valuations, everything will improve. The larger banks, because they are taking a weaker bank into their portfolio, will probably see a little bit of consolidation. But in the long run, the market will view this whole mergers positively, because you'll have a larger size bank which can tap international resources for raising dollar funds and creating much healthier balance sheets. So I think overall the market views this favorably for banking stocks.
The next question, sir. Is the second wave here?
Yes, the second wave is here in pockets, right? And I think that this time, having learned from the first experience, hopefully the second wave will not last for long and we'll be able to control it. But yes, undeniably the second wave is here, and we have to be careful about how we manage the situation.
The next question, sir. How do we know that GDP will be at 12% this year? What assumptions can go wrong?
So the assumptions which can go wrong is that this summer, they're expecting that last summer was a washout because of the lockdown. So consumer durables like air conditioners, refrigerators, water coolers, it's the big season for them. And last year that was very bad for them because the lockdown exactly coincided. So a good monsoon which had already come in means there's money in the hands of people. The summer is expected to be a blowout summer. So that's the basis on which some of these numbers are there. So one hopes that the Indian consumer actually goes and spends. So the risk is that the Indian consumer may decide to keep the money and not spend. So that's the mind of the consumer. But we do hope that all the advertising on television and the pent-up demand would create that kind of effect. That's one risk. Second is that FDI coming in is a big thing behind the recovery, because government of India doesn't have that kind of finances. So FDI has been coming in, but it's been mostly coming into the internet economy, the digital internet, financial, like Swiggy, Zomato, Byju's, those kind of economy. But the FDI we need to come in manufacturing, which is where the PLI. Now the PLI scheme and the FDI flowing in, if that gets delayed for whatever, I'm confident that it will happen. But in case it doesn't happen in the 6 to 9 months, then this year's growth projections may need to be toned down and shifted to next year. So those are the two key risks. The third risk in terms of the government spending on infrastructure, I don't think there's risk, because I think the Gadkari ministry is pretty much on the ball, and they will make sure that the spending happens as planned in the budget.
Next question, sir. Is it a good time to invest in the US market?
I would say it's a good time to invest in international markets, not necessarily only the US. US has already seen a joy run. I think that there's a lot of valuation has gone up, and there's a lot of risk now at the prices at which they are quoting. So while I would say that you cannot ignore the US, and US must always be a part of your portfolio, don't make it the only part of your international portfolio. Diversify across Europe, across emerging countries, across commodity rich countries. So I would say a diversified global portfolio will deliver better than a only US centric portfolio. But that being said, international equities clearly now have to become a part of your thing, because the rupee has been strengthening consistently. The long-term track record of the rupee is of a weakening to the extent of 4 to 5% against the dollar. So if you have a longer-term perspective, this strengthening of the rupee is actually a market correction which you should use to buy more international equities. So yes, good time to buy international equities, diversify it, not depend only on the US markets.
The next, sir. Sundaram MF insists that people visit the nearby branches for updating a change in bank details, whereas other mutual funds have provided the option to do it online with OTP authentication considering the COVID situation. Poor customer service, could you please get better customer service people?
Absolutely. I take your feedback and we will do the needful. One of the reasons was that we've just acquired this principal mutual fund. We are awaiting regulatory approvals. So a lot of features that are there in principle, not there in Sundaram, there in Sundaram, not there, we need to integrate it. So just I request your patience for a bit of time while we get our digital infrastructure into place. But I'm confident that as in when we get the approval, we are parallelly working on a stream of digitally making sure everything is online. And I'm confident that we will address this situation. Just give us a little bit of time while we work our way through this integration with the principal mutual fund.
The next question, sir. Considering that the second wave is here, will gold run up again?
Not necessarily, because the gold run up was partly due to the dollar's weakness, the negative interest rates on fixed income, and the COVID crisis. But a second wave is going to be in pockets, and I think it's going to be controlled. And if you look at the number of people getting vaccinated going up, those who get a vaccine will be out of the second wave effectively. Because I don't think there's been enough cases of people getting a vaccine and still getting COVID. Even if they do get, it's a very milder form and they don't get hospitalized or anything like that. So the proportion of people who will be subject to a second wave is coming down as the vaccination increases. So while a second wave is definitely on, I think it will be far more controllable. And I don't think it's going to have an impact economically, because I don't think a fresh lockdown will be anticipated. They will contain it. We have learned our lessons from the first one. So I think the second wave, while it will slow down the growth rate of the world, it will not be leading back to another recession. And gold rises only if there is a fear of a recession. So I don't think that's the case right now.
The next question, sir. Are we looking at any new NFOs?
We will do that after we complete the merger exercise, because there are a lot of principal funds which we need to consider. We are going through, we have submitted proposals to SEBI. So just wait, we do expect it won't take very long. Already the first set of questions has come from SEBI, we have responded. We do expect a fairly quick resolution, and an approval comes through, then I think we'll be ready to launch NFO. So maybe just give us the first quarter to get this merger situation done and dusted.
The next question, sir. What schemes are we merging with Principal?
I cannot divulge that because it's in the court of SEBI. So SEBI has to say yes, no. So kindly be patient with us for just a few months, and then moment SEBI gives us the green signal, we are happy to share the information with you.
We have just one more question, sir.
Okay.
Should we, is now a good time to invest in lump sums, or what strategy should we follow considering the markets have been a little topsy-turvy?
So I would say that the key is to have a broader market exposure. So if you are putting into a flexi cap or a multi-cap fund, then you can put lump sums because they'll keep readjusting it. So if you're managing your own portfolio as large cap, mid cap, small cap, I would recommend that you put it in STP form, put the money in a liquid fund and keep staggering it on market corrections or systematically, because the portfolio, every month you'll have to take a look and say, how much do I put in large, mid and small? So the ability to stagger your investments allows you to then stagger the allocation also. You could start off today by being, let's say, 70% large cap, but within 3 months, I would expect you to be 70% mid and small. You can make that micro fine tuning better if you stagger your thing, because volatility is here to stay. Because FII flows will come and go, news flows will happen. So this is not a smooth joyride of the market. There will be volatility. So in any volatile time, it's always better to stagger, basically to take advantage of the rupee cost averaging process. Also to take smart decisions in terms of asset allocation among large cap, mid cap, small cap. So I would say that on the balance, unless you trust some particular multi-cap fund and that fund manager, then you can probably allocate some lump sum to that flexi cap, multi-cap category.
So next question, sir. Which debt schemes should one invest in now?
So in debt, there are two thought processes that you should have been clear in your mind. Are you parking your savings bank money for ready liquidity? Or are you parking longer term money to kind of get better than FD returns? So if you're parking your short term liquidity money, then you have 3 or 4 types of liquid funds. There's a plain money fund, there's a money market fund, there's an overnight fund, there's an ultra short term fund, there's a low duration fund. All of these are in the liquid category, and slightly some take 30-day exposure, some take up to 1 year. So depending on your comfort with that, I would say that at this point in time, stay short. because interest rates are expected to rise in the medium term. So stay as close to the short end as possible. So liquid, those kind of schemes for money which you are just putting, instead of putting in a liquid savings bank account, you're putting it here. If you're putting it longer, obviously you should have a 3-year view because the taxation benefits kick in at the end of 3 years. So when you do that, when you're now in a rising interest rate scenario, again choose a fund with a 3-year outlook, which has the ability to reprice its assets because interest rates should be going up. This is not the time to take long-term exposure because as interest rates rise, mark-to-market losses will come and take away your gains. So accrual and repricing your assets are important. So high accrual will happen when you take corporate bonds because there's always a yield kick up which you get over G-Secs and over AAA from a corporate bond, AA plus AAA kind of a portfolio. So I would say go with a corporate bond fund. The other option is to use a floating rate fund or choose a fund with a 1-year maturity because those assets at the end of 1 year will get reinvested for another 1 year and reinvested for another 1 year. So any funds with a 1-year kind of a duration, so banking and PSU funds, right, ultra short term funds are good from that perspective because they take close to 1 year and reprice the assets. So you'll get higher and higher yields. So with a 3-year outlook, I would say corporate bond fund, banking and PSU fund, and any short-term fund. The short-term funds have 1 to 3 year durations. So they are the ideal for this kind of a product. So that's the way I would recommend you to allocate your portfolio. Basically starts off with what do you want with your money? Do you want liquidity or do you want better than FD returns? Then 3-year outlook and the fund size.
That was our last question for the day, sir.
Right.
Thank
Thank
you.
you. All the best to everybody and stay safe. Bye. Look forward to the next seminar.